Welcome to the latest Motley Fool scoreboard. I'm Anand Chakavaloo. We've got longtime fools Dan Kaplinger and Tyler Crow giving a 1 to 10 rating to, ironically, an individual stock that's behind ETFs. It's MSCI, ticker symbol MSCI. We'll talk about the business first, including factors like industry and competition. A 10 is invincible, a 1 is hopeless. Tyler's going with a 9, Dan's an 8. Let's start with the higher score.
It kind of baffles me when you look at MSCI and Morgan Stanley thought, this isn't a core part of our business. We should divest it. It really doesn't make us a lot of sense because this core business we all know is making indexes or indices, which, mutual funds use as benchmarks to underperform year in, year out, or they use them to build index ETFs. It has some risk management and ESG advisory services that are growing fast. It's all 97% of it is recurring revenue businesses, either tied to subscription fees or asset under management fees, and it has greater than 90% retention rate. So on revenue stability, it's great. Ridiculously high margins and high returns of capital. It's kind of hard not to love this biz, I guess, apparently, unless you're Morgan Stanley.
It's funny because you'd think that this business would just be kind of silly. It seems like something that you pitch a business model. It's like, what's your business model? Oh, we come up with lists of stocks and then tell people to invest in them. It kind of baffles my mind. You get paid money for that. But as it turns out, in the back room, there's a lot more to managing those indexes than you might think. And MSCI is just one of just a handful of companies that's managed to do it successfully. People know S&P Global probably better for the S&P 500 index, but MSCI has a ton of exposure, especially in international markets, had a lot of success with its indexes.
Management, a 10 is Warren Buffett, a 1 is Homer Simpson. Both of you are a 9 here. Why so high, Tyler?
Well, I actually gave this score here more for what management hasn't done rather than what it has, because the capital markets data providers over the past several years have been through this massive shakeup where others are making these mega deals. And in my opinion, I think they're destroying shareholder value when they do it. MSCI has mostly avoided this temptation of keeping up with the Joneses on going into commodities and all these other markets that people are blowing out their balance sheets to do. And the fact that they have stayed disciplined and know what they do well, is a real testament to them.
Yeah, 30-year veteran Henry Fernandez has done a good job since he came over from Morgan Stanley. He's won awards for top CEO performance for several years during his tenure. Early in his career, really interesting guy, founded his own private equity firm, was an embassy diplomat as well for the Nicaraguan embassy in Washington. Just speaks to his people skills, soft skills that I think really are not necessarily all that common in the financial industry, but have really helped MSCI over its tenure.
For financials, a 10 is a fortress, a 1 is yikes. Dan's at a 7, Tyler's at an 8. Go Tyler.
Well, some might say $4 billion in debt to $400 million in cash is scary. But look, I cut my teeth in energy and commodities. That's nothing, right? But to me, with such remarkably predictable high margin revenue relative to cyclicals like commodities, I think it can really afford to this modest debt load and use it to return capital to shareholders and do other things.
Some might say that debt is scary. That is me. But I have to say, too, I'm also a little bit wondering that, goodwill is over half of the assets on MSCI's balance sheet. That speaks to acquisitions that it has made over the course of its lifetime. But Tyler's absolutely right. The free cash flow exceeding $1 billion per year at this point. I might prefer to see a little bit more debt reduction with that money, maybe a little bit less on the stock repurchase side, but it's kind of hard to say that they're over-levered at this point.
Right, time to put our money where our mouth is. Dan, let's talk valuation. How well will MSCI stock do over the next 5 years? And how safe is it? Keeping in mind a 10 is a sure thing, a 1 is a lottery ticket.
I'm going with sort of my default 5 to 10% return estimate. If anything, I'm going to be at the low side of that, and I'm given a safety score of 6. There's no question. MSCI sales and profits have been consistently growing for years. It's the heyday of indexing. Everybody's looking at it. my unpopular opinion, ETFs and indexing, it's going to go out of favor at some point. People are going to get tired of having their S&P 500 ETF buy Supermicro at $100 a share and then see it drop to $25 a share. When that happens, I think maybe the MSCI has a little bit of difficulty.
So I went with 10 to 15 with a safety score of 8. I'm kind of judging it on what management says it's going to be able to do. It says its long-term target for revenue is low double digits between all of its advisory, ESG advisory, and its bread and butter business. Toss in some buybacks to juice earnings per share growth, and get somewhere close to the 15% range. So that's kind of within that range. I think valuation may be a headwind where it is right now, and a stock market crash could impact earnings and revenue because a lot of that revenue is assets under management based. Lower assets under management means lower fees. But overall, I'm pretty confident that management can meet these goals. They seem very attainable compared to other management teams that throw out pie in the sky kind of numbers.
Stan thinks the index company is going to roughly match the index, and Tyler thinks it's going to beat the index. Let's go on to top it. Tyler, is there a company in MSCI space you like better?
I mean, if I get out a bet on the other side, I could maybe make the case for Moody's or FactSet Research Systems because they're like the other capital markets data companies that didn't binge on M&A recently and may have actually benefited from some of like the divestitures from S&P Global and Intercontinental Exchange with like antitrust concerns. I think those three that we just mentioned, Moody's, FactSet, and MSCI, have returns on invested capital above their weighted average cost of capital, and the rest of the industry doesn't. So like those three are kind of where people should be in this industry.
Yeah, I don't really have a better pick. S&P Global, like I said up front, has a better known brand, but it hadn't done a good job of leveraging it. Spider ETFs, well behind iShares, well behind Vanguard, just haven't done a good job of pitching the knowledge, the brand awareness of the S&P 500. I think MSCI is a perfectly good choice here.
Thanks to both Dan and to Tyler. They've given MSCI an overall score of 7.7 out of 10. Short of that 8.0 that would force me to own shares, the lowest score was for the returns expectations, which honestly weren't bad. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is a company that sells one of the most expensive things in your house. Till then, Fool on.
It's kind of wild that S&P Global can't leverage it when you look at the fund flows for ETFs, like the bulk of it is all S&P 500 ETFs. Like that relative to Dow indexes is not even close.